And so welcome to the Q4 Quarterly Investment Review. Everybody should be able to see the presentation that we have, and hopefully you can all see us and hear us as well. We're looking forward to a couple of key things today. We're going to talk a little bit about the fiduciary rule. There's been a lot in the news recently about the fiduciary rules. So we'll talk a little bit about what is a fiduciary, what is the fiduciary rule, why is it in the news right now, what's happening, and what it means to you. And then we'll talk about the investment returns for Q4.
Yeah.
Sounds right?
Perfect. And as always, please feel free to jump in. And one of the things that we love to do as always, when we wrap stuff up is hear from you feedback on things that we could be doing better or some additional topics that you might want us to address next quarter. So if you have a moment while we're going through it, think of anything that comes to mind, please share it.
All right.
But maybe to get started, Jeff.
Yes.
So why is it that you were so excited about talking about fiduciary roles today?
Well, today specifically?
Yeah.
Because there's been a lot in the news recently. There's been, with the new president, there's been some news about the fiduciary rule. The fiduciary rule is something that was first proposed a number of years ago, was getting ready to be implemented, and then something changed. But there's also a lot of sort of, I think, confusion around what is a fiduciary to begin with, and what does this fiduciary rule mean? So we wanted to talk about that. I'm excited to talk about that. And in large part because, as you'll see when we go through this, first of all, the role of a fiduciary, which we're going to explain in just a second, it's not just a role. We look at it as a privilege, as an honor.
Mm-hmm.
So we get very excited, very passionate about the fiduciary role, and let's go ahead and explain what that means. All right.
So yeah, what is a fiduciary?
Okay. So it can be very technical, it can be very complicated. We're going to try to make it really simple today. First, we're going to talk about who is a fiduciary and what is a fiduciary. And then we're going to go into more detail. But let's just start with a very basic concept. Anyone who's using discretion to administer or manage the retirement plan is taking on a fiduciary responsibility. Okay? So if you're a fiduciary, what does that mean? A fiduciary is required by law to always act in the best interest of the plan participants. They must put the plan participants' interests ahead of all else, ahead of their own, ahead of other parties. They must act in the best interest of the participant.
Wait, but hold on. Before we go further, when we're talking about who is a fiduciary, so there's traditionally, before you guys became clients, for some of you who had 401k plans prior, there was somebody who used to sign the Form 5500. That person was a fiduciary.
That person's acting as a fiduciary. In fact, not just that person.
Yeah.
But I think anyone that was saying, hey, what investments should we offer our 401k?
That's a fiduciary.
That's a fiduciary.
What about the payroll person who's tracking employee eligibility and determining who is in fact eligible?
They're acting as a fiduciary.
Even tracking eligibility is a fiduciary act.
It's a fiduciary responsibility.
And approving loans or hardship withdrawals?
All of that is fiduciary roles that someone takes on. And if it's not explicit who's taking that on, it's probably the person that's doing it.
Got it. So maybe a simple way of high level, if you're doing anything with respect to administering the plan and you have any sort of discretion one way or the other, you're acting as a fiduciary.
You're acting as a fiduciary.
Okay.
And that brings, some people would say a lot of responsibility, some liability. We think of it as it's an honor. It's a privilege.
Okay. Perfect.
All right. So that's really sort of a baseline sort of the fiduciary and what it means to be a fiduciary.
Now, one other question is the requirement of a fiduciary. So it says here that they can act solely in the best interest of plan participants. So let me imagine a fiduciary issue that comes up.
Okay.
Let's say there's a question between what's good for the company and what's good for the employees.
Right. This comes up a lot, actually.
Yeah. So what happens there?
Well, the employee wins every time.
Got it.
That's the only interest that, as a fiduciary, you need to take. So what is in the best interest of the employee?
Got it. Okay.
Right? So that's what it means to be a fiduciary and who is a fiduciary. And actually, we already covered a lot of this because you sort of preempted my slide here, but there's a lot of responsibilities that fall under this role of a fiduciary. And we're going to spend a little bit of time going into a little bit more of these, but what investments are available in the plan, monitoring those investments, tracking eligibility, all of these are various fiduciary responsibilities. Okay? So I think we should, we sort of talked through these already. Let's move on now and just say, How serious is this?
Yeah.
Like what, okay, so you're a fiduciary, but I mean, what could really happen? And actually what could happen, it's not just what could happen, what is happening is that employees who feel that the fiduciary for their plan has not held their best interests at heart are getting sued. And it's interesting here, we're talking about, in this case, these are some recent examples that are in the news. These are employees, people that are employees of MassMutual in the MassMutual 401k suing MassMutual.
No.
Yes, because they felt that the plan was not operated in the best interest of the participants. And in large part, what they're talking about is the investment selections. The investments that were in the 401k plan were too expensive. The plan fees were too high, and that really hurts the employees in the plan. So we're seeing it's a very serious responsibility. But it brings real liability.
But these are huge companies.
These are huge companies, and it makes sense when you think about who's going to go, bring a lawsuit. You think, well, they're going to go after someone, big companies where there's a lot of money involved. But actually, it's not just big companies.
No.
Oh,
that's right. This was my slide.
Yes.
Got it. Lametre's collision, and this is a kind of was a wake-up call to a lot of folks in the industry
who thought that small plans would typically not face this type of scrutiny. And
that's right. So up until very recently, Lametre is actually one of the first ones. The suits, fiduciary suits, were really usually leveled against much larger companies because they have more assets and were more exciting targets for litigators. But then Lametre's collision came along, and this was a relatively small company. I mean, it had fewer than 100 employees, not that much in assets, about $9 million. They were actually sued by two really long-term employees. I think one had been for the company for 25 years, the other for 35 years. And they sued the firm for using expensive, actively managed funds when, I kid you not, low-cost Vanguard index funds were available. Now, ultimately, the good news is that they ended up dropping the lawsuit. So Lametre's didn't end up, I think, having to cough up any cash. But they certainly incurred legal fees. And it was a wake-up call that, nope, the spotlight is now increasingly on smaller and smaller companies. And Investment News had this interesting quote, which is basically litigation has ramped up and that we are now entering the most active period for new lawsuits in recent memory. And a lot of these lawsuits really come down to fees. Either the investment fees are too high, record-keeping fees are too high.
Or the arrangement of the funds and the way they're sort of kicking money back to the advisors that are recommending them.
Yeah, and that's an interesting one. That's the revenue sharing, which is traditionally smaller 401k plans. When they introduced investments, the broker for the 401k plan was interestingly getting commissions on the investments that he was putting into that 401k plan. And those kickbacks or commissions that he was getting, ironically, were higher the more expensive the funds were. And not surprisingly, we saw a lot of 401k plans that had really expensive funds that had really high commissions for the broker who was selling.
So there's in this case, the employees felt, hey, the fiduciary was supposed to be looking out for me and didn't do its job, and therefore they were sued. Okay, so now, I mean, that just sort of underscores the role of the fiduciary is really to protect the employees. There's also a way, though, that fiduciaries can help protect the employers, and that is by having the employers delegate their fiduciary responsibilities when it comes to the 401k plan to another party. And there's different ways, different roles, different types of fiduciaries that they can use to do that.
And before we jump into the specific different ways that companies and with our clients, we help you guys reduce your fiduciary liability, are there any questions about what is a fiduciary and what fiduciaries are responsible for? All right.
Maybe not. Okay,
cool.
Then. All right. So we talked about fiduciaries, and you say that so they're there to protect the employees, act in the employee's best interest. But an employer who typically takes on the role of fiduciary can delegate that responsibility to another party. And there's different types of fiduciaries that they can delegate to. So there's something called a 316, which is a plan administrator fiduciary. So we talked about tracking eligibility, communications approving hardship distributions, things like that. That all sort of falls under the 316. And then there's an investment advisor, which is something called a 321. And then there's a slightly more, I guess, higher level of fiduciary protection called the 338. And we're going to go through these in a little bit more detail. But 316, 321, 338 are three different types of fiduciaries. And let's take a look at what they do. Okay? So what a 316 fiduciary is responsible for. So a plan can hire someone and name someone to specifically be the 316 fiduciary. They're the named plan administrator, and they're responsible for making sure the plan is operated in accordance with the plan rules and DOL requirements. So things like tracking eligibility, processing hardship withdrawals, reviewing and signing IRS required filings, including the Form 5500. These responsibilities can be delegated to a 316 fiduciary who can take on much of that liability and responsibility from the employer.
This is riveting stuff.
Yeah, I know. In addition, there's something called a 321 and a 338. Now, these have to do with who selects and monitors the investments.
Got it.
So since you're our investment guru, do you want to talk about the difference between a 321 and a 338?
Yeah, so I'd love to. So 321, they call them co-fiduciaries. It's somebody who is sharing the responsibility of selecting and monitoring the investments with the employer. Basically, imagine you're the sponsor.
Okay.
I'm your 321 advisor.
Okay.
I'm saying, hey, Jeff.
Yes.
Buy low, sell high.
Sounds like a good advice.
Then you have to decide whether or not
I'm going to do it.
You're going to do it.
It's still up to me to decide. Yep, good advice. I'm going to do that.
Perfect. So let's say it was bad advice, and we really should have bought high and sold low, and employees sue us. Well, they're going to sue both of us, right? I gave the recommendation, but you decided to act on it.
It was actually ultimately my call. I had the final discretion. Okay.
So 321 is sharing that fiduciary role. I'll make recommendations as the advisor. You decide whether or not to do it.
Decision.
We're both on the hook.
Okay.
338 is a significant step up from that in protection. The 338, which is what we do for our clients, is we say, nope, we are going to be fully responsible for selecting and monitoring the investments. We're going to keep you in the loop.
Sure.
In our quarterly investment performance meetings.
That's what we're going to do now.
And one-on-one meetings with our clients.
Yeah.
But ultimately, we're going to decide what should be in the, we're going to do the work to select and monitor the investments and make the ultimate decision.
You being for us all.
We're being for us all. So if we get sued now and somebody decides that the investments
were too expensive, the plan fees were too high.
I'm getting sued.
The 338.
Anybody could sue anybody.
Yeah,
but I'm actually first in line. And in fact, as a 338, any reasonable 338 should indemnify you, which we do, to any lawsuits resulting from related to the investment selection and monitoring.
So when it comes to investments, 338 and 321 are two types of fiduciaries. 338 really takes the responsibility, makes the decision, has the discretion,
and the liability,
takes the responsibility and liability. 321 shares it. And a sponsor, an employer, can delegate their liability this way to these fiduciaries. So fiduciaries look after the interests of the participants, and employers can hire fiduciaries to help them protect themselves as well.
And interestingly, 7 out of 10 companies that are smaller businesses hire an independent fiduciary to help them exercise their duties. And most of the time, it's really a 321 or a 338. The 316 fiduciary is a relatively newer classification that people are taking on.
Right.
So, are you going to tell us what we do?
Let's talk about actually the fiduciary rule
first.
Yeah, we're going to talk about the fiduciary rule.
You're going to leave everybody in suspense.
So the fiduciary rule was legislation that had been proposed back in actually several years ago. It was set to take effect, and let's go ahead and take a look at it. It was set to take effect beginning to take effect, I think, this coming April. What the fiduciary rule had proposed to do was to expand essentially the definition and include a number of people who, at the moment, were making suggestions and giving advice to 401k plan participants, but weren't taking on the full responsibility of a fiduciary. So the fiduciary rule was a proposal that says, hey, anybody, basically anybody that's going to be advising as to what funds go in there or what funds someone should use needs to act as a fiduciary. That would have really expanded the role and held everybody involved in retirement plans to a higher standard.
Whoa. So the brokers that were picking investments that generated huge commissions for them?
Yeah. Would have had to change their business practices to ensure that what they were doing was always in the best interest of the participants. Shocking, but they're actually not held to that standard today.
So they didn't have to actually act in the best interest of their clients?
No, they didn't. So they just had to act to a dramatically lower standard, which said, hey, if it's generally suitable, it's okay. Even if there's a better alternative for them here, two funds, both investing in the S&P 500, this one has much higher fees, and I, as a broker, got a big commission. That's okay. I can recommend that because I'm not acting as a fiduciary. Well, this fiduciary rule would have said, no, you can't do that anymore. So this would have been a massive change to the way a lot of investment firms, broker-dealers, et cetera, are working in terms of the retirement plans. And it would have required, so changes in business practices would have held everybody to a much higher standard. And actually, I mean, we thought that was good. If anything, we thought that the fiduciary rule maybe didn't even go far enough because there were some carve-outs, some exceptions, but it would have imposed a much higher standard on everybody with regards to acting as a fiduciary with retirement plans.
Just an interesting side note.
Interesting to whom?
Well, to me.
Okay.
And maybe you guys.
Sure.
But we had a number of, so this rule was going to go into effect.
Yeah.
I think was probably being the operative word, but I don't want to steal your thunder.
It's okay.
It was going to go into effect, and so we actually had a number of 401k plan sponsors reach out to us earlier this year when they got letters from their brokers saying, I am so sorry, I can no longer actually act as your broker or advisor on your plan because I can't charge commissions anymore, and I'm not willing to actually act as a fiduciary. And so these were large, it's the names that you would expect. Morgan Stanley, Merrill Lynch, a lot of those names were going to be getting out of the 401k advisory business because they couldn't make money or they did not want to change their practice to comply with the new fiduciary rule.
Yeah. So the fiduciary rule, so that's a little bit about what the fiduciary rule is. Now, it's been in the news recently.
Why?
Because with the new administration, they have effectively hit the pause button on the implementation of this rule and ordered a review of the rule. And what many people would say is, and Trump, I think, has been very clear, he's not a fan of the fiduciary rule. And it seems unlikely that the fiduciary rule will actually be implemented. Now, it's just paused at the moment. To be clear, it has just been paused, so it doesn't take effect on April 10th when it was originally intended. And now there's new, most people believe it is unlikely to actually become implemented.
So the fiduciary rule that was going to require anybody who's helping 401k plans to act in the best interest of employees is no longer going to require them to do that. Interestingly, do you remember like a minute ago, I told you about the clients that reached out to us because they got a letter from their broker saying they can't work?
Yeah.
Well, in about the last couple of weeks, a lot of those clients got letters from their brokers saying, by the way, just kidding, I'm now going to be able to continue to work on your 401k plan.
So the fiduciary, so this is why it's been in the news, that this rule has been paused and may actually not go into effect.
Whoa, that's a little worrisome. What does it mean for everybody here?
For the folks on this call, what does it mean? Actually, not much, because for us all acts as a fiduciary already. We hold ourselves out as fiduciary. We provide fiduciary protection to the employer, act as a fiduciary on behalf of the employer. So everyone's plan is already covered with both a 316 and a 338 fiduciary protection, and but only because that's what we've chosen to do. That's how we act as an advisor. So the change in the rule will have no impact on the folks on this call.
Because we just always thought that that's the right way to do business.
And we thought that that's how everybody should do business, but not everybody does business that way.
Yeah.
So that's what the fiduciary roles are. That's what it means to be a fiduciary. That's what's happening with the fiduciary rule. And if there's any updates or material changes to the fiduciary rule in terms of its status being implemented or not being implemented, we'll cover that in one of our upcoming performance reviews.
So let's pause there. So that was thank you, Jeff. I'm a fiduciary geek, and I personally really, I mean, at a very deep personal level, I do think that it is an honor and a privilege.
Yeah.
Because fundamentally, what we're doing as fiduciaries is but by protecting employees from excessive fees, we're helping them save and keep more of what they've earned, and that has a huge impact on what they're going to have at retirement. So I do think, at a very personal level, in all seriousness, it's one of the things that I'm most proud of, and I think that there are a lot of other providers, not just Borisall, that have the same orientation.
Yep.
So let's pause there, and I'd love to open it up. I know that there are a lot of want to see if there are any sort of thoughts or questions or commentary on any of the fiduciary material that we've covered before we start diving into the investments.
Okay. In that case, what we said, one of the key roles of the fiduciary is to select the investments that go into the 401k and then to monitor them. And so a key part of that monitoring is this quarterly investment performance review. So we're going to go ahead and we're going to turn our attention now to the investments.
Awesome.
All
right. So first off, what I'd love to do is cover what happened in the overall markets. And just so we have some context before we jump in to see how the individual mutual funds and the 401k plan performed. So Q4 was kind of an exciting roller coaster of a quarter. On the positive side, go America, U.S. stocks
did extremely well.
The big winner in the world. In fact, the S&P 500 was up 3.8% for the quarter. Yeah. International developed stocks. So these are countries like Japan, UK, France, Germany, the big developed non-US countries. They were largely flat, kind of declining by about a third of a percent. Emerging markets, however, declined more significantly at about 4%, largely because emerging markets are heavily dependent on commodity prices, and commodities didn't do so well in Q4. Then we have bonds, both the U.S. bonds and international bonds declined, about 2% to 3% each, and this is primarily because yields are going up. And whenever yields or the interest rate goes up, bond prices go down.
All right. Interest rates up, bond prices down. That's what we saw in Q4.
Yeah. So at the highest level, that's what we saw. And I'd love to dig a little bit deeper, particularly around the international. And this is really how the countries performed that are in those two international indices. And not surprisingly, when we look at right here, these are the companies that generally make up the developed markets. Okay. You see that most of them were down significantly. So Japan, which I think it comprises like 24% of the developed market index, was down slightly at about 0.5%. UK, I think they come in at somewhere about 18%. They were down 1.25%. So you saw some of the biggest constituents of the developed markets really were down in many ways significant. The poor folks in New Zealand, they had a really tough quarter, 11% decline.
Yeah. But how big is that impact on the overall group?
It's very small.
Because New Zealand is just not that big an economy.
It's a great island. Great island. Okay.
Yep.
But thanks for holding. We appreciate your patience. Did you know that MVIX offers an expansive array of digital signage solutions and interactive signage kiosks? Have a custom project in mind? Ask our solutions consultants. Please continue to hold. Someone will be with you very shortly. Thanks for holding. We appreciate your patience. Did you know that MVIX offers an expansive array of digital signage solutions and interactive signage kiosks? Have a custom project in mind? Ask our solutions consultants. Please continue to hold. Someone will be with you very shortly. Thanks for holding. We appreciate your patience. Did you know that MVIX offers an expansive array of digital signage solutions and interactive signage kiosks? Have a custom project in mind? Ask our solutions consultants. Please continue to hold. Someone will be with you very shortly. Thanks for holding. We appreciate your patience. Did you know that MVIX offers an expansive array of digital signage solutions and interactive signage kiosks? Have a custom project in mind? Ask our solutions consultants. Please continue to hold. Someone will be with you very shortly. Thanks for holding.
All right. There we go. Perfect. Thank you, Jeff.
So we're going to periodically unmute everyone so people can ask questions again, or you can use the chat. We've had to mute everybody because looked like there's a little hiccup there with one of the attendees' messages.
Perfect.
So let's continue.
So that's what we saw at the overall in the developed markets, and we saw a similar pattern with the emerging markets. So some of the largest constituents of the emerging markets had some significant declines, although Russia actually did quite well.
Just interesting. Q4 they did well. Okay.
They did very well. So that's what we saw on the international stock scene.
Okay.
And then with respect to bonds, this is something that I know that we talked about. We've really been talking a lot about bond yields for the last couple of investment performance reviews, and that's because generally bond yields have been increasing. So this left graph right here, this shows the U.S. Treasury yield curve. Basically, it just shows you how much it costs to borrow money over different time periods. So when we look at this 9/30, this is where yields were at the end of Q3. Basically, if you wanted to borrow money for 30 years, the U.S. Treasury yield curve was about 2%. Well, fast forward 3 months later after the election, suddenly it's almost a 1% increase.
And why is that?
Yeah, well, I think a lot of it is because of expectations of a tightening monetary policy. So the new administration is generally there are a number of, both from a regulatory perspective, they have been deregulating particularly financial services. And secondly, a tighter monetary policy, rising interest rates or increasing interest rates, generally also benefits financial service providers. So banks in particular.
Okay. Yep.
So we see that a administration which is generally more which is taking a very positive stance towards particular financial interests. Secondly, you see a lot of the policies that are being discussed right now at a national level include significant increases in infrastructure investments. So that now we're talking about potentially a much more expansionary fiscal policy. That creates some concerns among those in the market of increased inflation. And so when we see increased inflation, we generally see higher interest rates. And then, of course, when you look at the federal bank is now beginning to be more confident that the U.S. economy is showing consistent, sustained growth. And as a consequence, has been signaling for a while.
So this is what we mean when Janet Yellen is talking about maybe we're going to need to raise interest rates.
Yeah.
That's the type of signaling we're talking about.
That's right. In fact, I think she's actually talking later today in about an hour. Actually, maybe she's starting to chat right now in Chicago, where the market is broadly expecting her to signal in a much more hawkish manner a rise in interest rates. And so, not surprised, it's definitely what we saw. And when we look at the second part, so that's the overall interest rate environment. And then the second graph shows you what sort of yields you get when you look at different types of credit quality. So the 10-year Treasury, that's arguably one of the safer credit risks that you can have because the U.S. government tends not to default on their bonds. In fact, they haven't ever. And then over to the right, you see higher credit risk. And generally, one of the things that we've seen is over the last quarter, which has been a continuation of a secular trend with credit spreads, is that the difference between what a risk-free rate might be with a treasury and a riskier bond, corporate bonds of A to B, have been tightening and have been narrowing. And that means that investments in riskier corporate bonds have been doing relatively well compared to other bond investments.
So they don't have to pay as much of a premium for the risk.
Yeah, and so this largely explains why we've seen what we've seen with the overall bond index returns.
All right.
So that's a quick overview.
So what does that mean
what we saw in the markets?
Yeah, so we're going to talk about our funds now, or I shouldn't say our funds, but the funds in the 401k.
Yeah, let's turn to that. So we talked about the key takeaways. Oh, one last thing. How could we forget the election, Jeff? How could you forget the election?
I have no idea how anyone could possibly not be thinking about that.
And we talked a little bit about this at our last quarterly market return. But I thought that this was a really interesting thing, especially in lieu of the phenomenal rally that the market had post-election.
It's been quite a rally.
It has. In fact, between Election Day and the inauguration, the S&P 500 was up by about 5.82%.
So Election Day was November 8th. Inauguration was January 20th. All right. So in that time period.
We saw the overall market increase 5.8%. That's actually one of the biggest run-ups between election and inauguration that we've ever seen. I mean, John F. Kennedy. Yeah, but he almost got like 8 or 9%.
Right, but in recent memory, Trump has absolutely had the largest increase in stock market returns between the time he was elected and the time he took office.
Yep, and Barack Obama.
Not so much.
Actually, was down 20% during that time period.
Yeah.
Now, here's the thing. There are a lot of things that are going on between the election and the inauguration that have significant impacts on what the market does. If you recall, during that period for Barack Obama, the financial services sector was in free fall. Everybody was worried. You might say that they were worried about a change in administration, a new Barack Obama president. You could say that the market was worried about that, or maybe they were excited about it. We don't know, because everybody was entirely freaked out about
panic.
Yeah, are the banks going to still be around in February?
Right, it's just a whole different thing.
Yeah, and so this is one of the challenges of drawing any sort of conclusions on the S&P 500 returns from the election day to inauguration. Is it's really not a very good predictor of what's going to happen afterwards. And let's
pull that up. During the tenure of the actual presidents, right? So we don't have Trump on this slide because his tenure has just begun, and we don't know what the impact is going to be.
That's right.
But you look at everybody else.
And even though Barack Obama had one of the worst market returns between elections, he actually had a very strong overall market return
during his
time period. It was opposite was true for a number of the other presidents that are included here. Yeah. And so generally, I think our approach, which we alluded to previously, was that who gets elected generally doesn't seem to have whether it's a Democrat or a Republican, doesn't seem to have that big of an influence on what the overall stock market does over the period of their presidency. There are just other factors that are so much bigger, like, is the world going into a global recession? Is there a financial panic? Right. Those factors have a much bigger impact on equity returns. Okay. So that's the quick overview. Let me go forward and talk about the investment performance. And I see that we're about to run out of power.
All right.
Can you grab a charger? So turning to the investment performance. So the first thing we do is look at the overall allocation of assets in the in our plan, and what we see is about 80%, which is consistent from before. About 80% of all assets in the Forrestal 401k across all clients are held in the target date funds, and this is really important because this really just shows that most of the assets are diversified at an age-appropriate level of risk. And more importantly, these portfolios are going to be managed, and those risk is going to decline as necessary as people get closer to their retirement age. Now, the 20% that is individually managed, these are employees that are going in and creating their own portfolio. So one of the things we always like to look at is
what are those people doing that if they're not in the target date fund, how have they invested their money?
Yeah, and generally what we would be concerned about would be a pie that's not at all diversified.
Like
all cash.
One slice pie.
Yeah, all cash or all stock.
Yeah.
We're very heartened when we see that those people that are taking the initiative to creating their own portfolios are actually doing so in a way that is generally consistent in aggregate with what we would expect prudent portfolios to look like. And generally we're looking at like an 80-20 stock bond split. And when we look within the stock allocation, you see that the largest constituent is the S&P 500.
Well-diversified sort of group of large cap U.S. stocks. So
that's right.
Yep.
And then you have the mid cap, and then you have the small cap.
Yep.
Roughly, not exactly, but roughly in overall market proportions. Mm-hmm. So when we look at this is a great sign that the overall investments across all clients is actually very healthy.
Yeah. So what this really means is, look, most people are in a target date fund, which we know, well-diversified, low cost. Those that aren't using, and people are defaulted into that, so that's great. People that aren't doing that are actually making good decisions as well. So the folks that want to exercise their own discretion, they're doing so prudently. Those that want help, we know they're getting good help.
Perfect. I'm going to take a risk, and I'm going to unmute everybody and ask for questions. Let's see.
Okay, you're gonna hit unmute all there.
Unmute all.
Yeah.
All right. Are there any thoughts or questions from anybody on the line? Nope. All right. So let's continue then. So now let's look at how the individual mutual funds perform. Now, as a reminder for those, if this is the first meeting you're joining.
You're going to tell us this is the most boring investment review that they'll ever be part of.
Yeah, except for the one that we're going to do next quarter, which will be very similar to the one this quarter. Right. And this is that over this, one of our core investment philosophies is that we should be in the business of lowering risk for employees and lowering fees so that they have a less bumpy ride to retirement and are able to save and keep more of what they have saved by not paying exorbitant fees.
So low-cost investments is a really cornerstone of the whole approach.
That's right. And because we believe in investing in more index funds as opposed to more expensive managers that are trying to outperform the market, what that means is that over the short, when we compare ourselves to most mutual funds, we're going to see that sometimes the active managers, it's a coin flip, really, over a 1, 2, 3 month period, even a 1 or 2 year period. But sometimes they're going to outperform, sometimes they're going to underperform over the quarter, and sometimes it'll be mixed over the 5 year. But generally, when we look at the longer horizons, we should see the low-cost index funds win out. And that's certainly what we generally see with the large cap and total stock index funds. And then when we look at the mid-cap funds, it's the similar story. This time, they happen to underperform relative to the active managers over the quarter. But when you look at the 5 and the 10 year, yep, they pull ahead as expected because they have lower fees. Similar story with the small cap. And the international equity did better this last quarter, a little bit below over the 5 year, but they pull ahead over the 10. The total bond, similar story. Short-term bond, similar story. And the target date funds. This is what we want to look at most closely because this is where the bulk of the retirement assets are in and where the vast majority of employees have their money invested. Mm-hmm. And so here, when we look at across the board over the last quarter, really, Vanguard did fairly well. For most, over the last quarter, for most of the vintages, they did better. But at the longer horizon, they did a little bit worse than the active managers. But then when we look at the 5 year and when we look at the 10 year, they really outperform. And this 10 year outperformance is striking. What we're talking about is over 1% per year of better performance. And that largely is attributable to two things. The Vanguard target date funds in this plan are on average around 0.14 or 0.15% in fees.
0.14, 0.15.
That's like 0.14 of 1%.
Yeah.
When we look at the median target date fund, those expense ratios on average typically are more than 1% to 1.5%. And that expense ratio differential, that actually makes a difference.
So 0.14, 1.4. It's a 10x difference.
Yeah. It's quite, well, I guess 10x would be 1.4, but
that's what 1.4 versus 0.14.
Oh, look at it. Yeah, right. 10x. Mm-hmm. 10x. So that's what we see, and that's what we would expect, and that's what happened. So that's the quick overview on the returns for the investments in the plan for this last quarter. Let me pause there. Any thoughts or questions? Okay. All right. Well, if you have any questions on the fiduciary material or the investment performance, and you would like to schedule a separate one-on-one call with us, please don't hesitate to reach out. Similarly, if you just want to shoot us off an email, you can do that too. What I would love to do now is really open up the call, and now that we've gone through the fiduciary material and the investment material, this is really kind of our opportunity to ask a favor of you. And what we'd really love to hear is what we could be doing better. Either for you as the employer, if there's something that we could be doing to make your life easier, if there's something we could be doing to we could explain better, or if you've heard any feedback from employees, positive or negative, we'd love to hear it. Any thoughts? Okay.
All right.
Well,
We'll take that as a good sign.
We'll take that as a good sign.
But if there are things, please, we do really value the input and the feedback we get from our customers, our key sponsors. So send us an email, give us a call, let us know if there are things that we could be doing better, if there's some new things you'd like to see us doing that we could do to make your lives, your participant lives easier or better.
Okay, perfect. Well, listen, thank you all so much. And unless there's anything else, we will conclude this quarter's investment performance meeting. All right. Listen, thank you all so much for joining us on a Friday.
Thank you.
I hope you have a great weekend.
Have a great weekend.
And can't wait to chat with you guys next quarter.